Turkey's central bank is taking aim at rising prices after inflation rose to nearly 12% in October. It's hiked the key interest rate by 475 basis points to 15%.
A rise in interest rates can make the Turkish lira attractive again, but I don't think this is a long-term solution. The only solution is production. We have to get better in manufacturing.
The central bank says it's taking other steps to make goods and services more affordable.
The permanent establishment of a low inflation environment will affect macroeconomic and financial stability positively through the fall in country risk premium, reversal in the dollarization trend, accumulation of foreign exchange reserves, and the perpetual decline in financing costs.
One of the factors driving up domestic prices is the depreciation of the Turkish lira. The global economic slowdown brought on by the coronavirus has restricted the flow of investments to developing economies like Turkey. Investment demand in the country's real estate sector shot up by 21% between January and October, compared to the same period last year. To bridge this gap in the demand and supply of funding, the government doled out $20.5 billion in cheap loans to 8,396 firms. Concessional lending and other government steps have helped existing businesses stay afloat despite lockdowns and other restrictions. It's also encouraged more than 12,200 new businesses to launch. That's 14% more than the same period last year. But the government has had to borrow from international lenders to do this, and it's planning to lower its own cost of borrowing by issuing bonds over longer periods.
We will achieve a higher quality and stronger debt profile by adding a maturity extension to our country's low debt stock.
Ankara is also launching reforms to boost its foreign exchange reserves and make Turkish businesses more competitive. Under the program, the government will facilitate businesses in technology and other emerging sectors to create more jobs for skilled workers. Ankara will offer special incentives to international investors for ongoing and greenfield projects, and President Erdogan says structural reforms will reduce costs and boost returns for Turkish businesses. That could help further strengthen the local currency and deliver a much-needed shot in the arm for the economy. Mobin Nasir, TRT World.
Joining me now is Erhan Aslanoglu. He's the Vice Rector of Istanbul's Piri Reis University. Great to have you on the program with us. What's your take on this decision by the central bank? Was it the right move?
Thank you very much. Yes, I think that's the right move. For a few months, Turkish central bank was implementing policies which was reactive to the market movements. But now, today, after months, Turkish central bank gave clear messages to the market and just move in front of the market. That's a proactive policy, and the message was clear that the fight will be more inflation. The focus will be more on inflation. So I think that's the right move. But from now on, the target should be not the single-digit inflation, but the inflation target that has been missing for years, 5%. I think that should be the new target for the Turkish central bank, not single-digit inflation.
We saw the lira jump almost 3% immediately after this decision was announced. That's certainly welcome news. We've seen months of lows for the lira. Do you think this is just a short-term easing of pressure on the lira, or do you think we'll see more of a rebound?
Actually, it will depend on the reforms that the government is trying to do or gave the messages to implement. But this is the signal or the rate decision of the central bank today will make Turkish lira more attractive for both domestic and foreign investors. So I expect for at least for a few months a stability in Turkish lira and most probably an appreciation of Turkish lira. So it can extend, it can be longer, and it will basically depend on the economic reforms and economic and non-economic reforms of the government, basically. But this move is a very clear message to make Turkish lira attractive. And the main point to observe will be whether the locals, domestic residents, will move more Turkish lira deposits rather than the foreign exchange deposits. That will be the first signal whether the Turkish lira will appreciate or depreciate. But my guess, my expectation is that there will be some demand for Turkish lira deposits, Turkish assets.
You call this a more proactive strategy by the central bank. What other measures can we likely see put in place down the road to try to achieve macroeconomic stability?
I think we need some, not only for central bank, for other institutions of the government, like banking regulation and supervisory institution. We have, for example, asset requirement from the banks that should be abolished, I think, because it prevents banks to make more attractive the Turkish lira deposits. So maybe such technical measures is necessary to make the arrangement in the markets. But if the main target is to fight with the inflation, we should focus more on the factors that is causing the inflation in Turkey. First of all, we should give less current account deficit. And so the policies should aim to raise Turkish exports and to lower Turkish imports as much as possible. But it will take time. It's not a matter, it's not a business for a few days, few months, but we need a more reform agenda for this. And the second one is that the food prices and agricultural prices are very important, is one of the major sources of the inflation in Turkey. So we need a more comprehensive reform for Turkish agriculture and food industry to have more stable and lower food prices in Turkey. If we achieve to fight with inflation in Turkey, then we will achieve lower interest rates and more sustainable growth.
All right, we'll leave it there. Erhan Aslanoglu, thank you.